We're watching one of the biggest financial gambles in history play out in real time. I'm talking about big tech betting the entire farm on artificial intelligence. And the stakes, they're just absolutely staggering.
Okay, let's just put a number on this. Almost $700 billion. That's the mind-boggling amount that just 4 of the world's biggest tech companies are expected to pour into AI in just 1 year, 2026. This isn't just another line on a budget, not even close.
No, this is what they think is the price tag for winning the future. For these companies, this spending isn't optional, it's a strategic necessity. It's the cost of entry in what's become an all-out race for AI dominance.
All right, so let's really dig into this massive bet. Who are the players here? And just how big is this investment really?
So the companies placing this huge wager are what we call the hyperscalers. We're talking about the giants, Alphabet, Amazon, Meta, and Microsoft. And here's the crazy part. That nearly $700 billion figure for 2026, that's a 60% jump from what they spent in 2025, which was already a historic amount. The acceleration here is just, wow.
You know, when you see spending like that, you have to ask, why? What's going on? And the answer is pretty clear. We're watching a full-blown AI arms race unfold.
So where is all this money going? What are they actually buying? Well, it's the fundamental building blocks of AI. Think ultra-expensive, high-powered computer chips, mammoth new data facilities, the most advanced networking tech you can imagine, and of course the brilliant people you need to build and run it all. And this quote from Meta CFO Susan Lee really just says it all. It perfectly captures the mindset inside these boardrooms. She was asked about how they're allocating their money, and her answer was crystal clear. Being a leader in AI is their highest order priority. It literally comes before anything else. And the strategy behind this is it's absolutely crucial to understand. According to analysts at Deutsche Bank, this isn't just about building cool new tech. It's about building a meaningful moat, a massive financial and infrastructure barrier that makes it practically impossible for smaller players to even think about competing. But, of course, an arms race like this comes at a very, very steep price. And this, right here, is the central tension of the whole story. The absolutely dramatic impact this is having on these companies' financial health. Specifically, we need to talk about their cash flow. Okay, before we get into the numbers, let's just quickly get on the same page about a key term, free cash flow, or FCF. Super simple, right? It's basically the cash a company has left over after paying for everything it needs to run and grow the business. It's a huge sign of financial health, and it's something investors watch like a hawk. And this is where it gets very real. Just look at what's happening to Amazon. Because of all this AI spending, their free cash flow, that super important health metric, is projected to just completely flip. It's going from positive all the way into a deep deficit in 2026. And listen, we are not talking about a small dip here. Analysts at Bank of America think Amazon could be looking at a deficit of up to $28 billion. That is a truly massive amount of cash to burn through in a single year. And it's not just Amazon, not by a long shot. This cash squeeze is happening across the board. You've got Alphabet and Meta. Their free cash flow is projected to plummet by almost 90%. And Meta is even expected to go negative in 27 and 28. Even Microsoft, who's doing the best out of the bunch, is still looking at a 28% slide. The trend here, it's just undeniable. So you gotta wonder, how is Wall Street taking all this? Well, this spending spree has basically split investors right down the middle. It's kicked off this huge debate. Is this a brilliant, necessary bet on the future? Or is it a reckless, cash-burning gamble? And you can see the two arguments pretty clearly. On one side, you have the bulls. They say, hey, this creates that meaningful moat we talked about. This is a generational opportunity to meet totally insatiable demand. But then you have the bears, and they're pointing to this shocking cash burn, the uncertain return on investment, and just the immense pressure this puts on their profit margins. And this quote from Barclays analysts talking about Meta, it just perfectly sums up the bear case. I mean, when you have seasoned, professional analysts using the word shocking to describe where a company's finances are headed, you know things are getting pretty wild. But then again, there's another way to look at it, and investor Jake Dollarhide sums it up perfectly.
He basically says, look, making these incredibly tough, high-stakes calls that might hurt your cash flow in the short term, well, that's exactly what CEOs and CFOs get paid the big bucks to do. That is the job. So all of this, it brings us to the ultimate trillion-dollar question. The one that this whole situation poses for the entire future of tech, and really for investing itself. First off, can they even afford this gamble? Well, for now, yeah. These four companies are sitting on a combined war chest of over $420 billion in cash. That is a lot. So they can fund a huge chunk of this themselves. But even that might not be enough. We just saw Alphabet have to go out and raise an extra $25 billion in a bond sale. And this is the prize. This is what justifies all of it in their minds. The goal isn't just to be a market leader. It's to achieve total dominance over what many people think will be a multi-trillion-dollar market. We're talking about a generational opportunity where the winner could literally reshape the entire global economy. So that leaves us with this final, pretty provocative thought. As the cost to even compete climbs into the hundreds of billions, is a willingness to just burn through cash, to even go into the red, the new price of admission? Is that what it now takes to play at the very highest level of the technology game?